Good morning, good morning, good morning. This is the Morning Blast with myself, Ryan, and of course, Mr. Michael Brown, your very candid morning podcast on all things related to markets. As usual, nothing discussed on this podcast is trading or investment advice. Don't be so fucking stupid. Do your own research. This podcast is labelled as explicit because the occasional swear word does slip out. We do not apologise for that. There is also no editing that goes into these, so what you see is what you get, or I guess what you hear is what you get. Michael, how the devil are you?
Yeah, very good morning to you, Ryan. Good morning, everyone. Happy Wednesday, isn't it? We're halfway through the week.
All day.
Indeed, it is. Yes, I mean, it feels like every day is kind of blurring into one of these.
Yes, as our dear friend Polemic Payne on social media on his latest blog post this morning, and I've got to say, do subscribe to his Substack that he started doing recently because his daily update, his daily blogs are very, very good reading. And as he coined the phrase today, whoa, war on, war off. Basically, it's in Karate Kid vibes. And again, I've just seen you posting actually potentially was it a 15-point peace plan or something being sent over to them or something like that?
Yeah, well, I mean, we'll get on to the Middle East stuff momentarily, but when I was preparing my notes for this podcast this morning, yes, listeners, I know that will come as a surprise. There is some degree of the script in front of me. You know, you sort of tally up on one hand any positive headlines that we've had over the last 24 hours. You tally up on the other column the negative headlines that we've had over the same period. And to be completely honest with you, as I've said in my note to clients this morning, they basically just net each other off at this point. And this comes back to what I was saying yesterday and what we were discussing, which is there's just so much news out there that basically you can find any headline you want to justify any narrative you want at this point.
Indeed. So stepping away from headlines for a second, let's get an update.
Someone who doesn't pay attention to them at all.
No, someone that messages us when the market's moved a shit ton and say, what just happened?
What's happened?
And then we let him know. And he said, oh, thanks for that. It's blown through all my levels. But anyway, speaking of levels and what the market did yesterday, update from Clive Lambert, our dear friend Clive Lambert, over at Futures Techs. So things seemed a little bit calmer this morning. This is obviously as we went to print. God knows what's happening when you listen to this. Equities have been relatively quiet, had a relatively quiet time of it since we last wrote yesterday. S&P dipped to the Marabouzi support at 6,571, where buyers returned 6,675, the level we cited as resistance yesterday, weighed in late into the session. DAX bounced from a low of 22,545 and is eyeing resistance at 23,350. FTSE futures back above 10,000. The 200-day simple moving average is down at 9,640. So want to keep an eye on there. So we put some distance on that. So the bulls will be happy there. Bund futures posted a hammer candle yesterday. Some more signs of life from the bulls down here. Ditto for T-notes. I was very close to reading out dildo then for some reason.
3.5 minutes and it's descended. That's actually quite good going for us.
Clive could have written dildo instead of ditto, and I would have read it out.
Give the man ideas.
He's very aware that whatever he puts on this little script for me, I will read out no matter what it says. Forex markets, they marked time and took a bit of a breather, as did Bitcoin yesterday. Still kind of keeping an eye on that 74,500 level that we seem to say every day. Gold, silver continues their recent recovery. Gold has been up to 4,600 overnight, well off Monday's 4,100 low. Silver testing resistance at 75.00 for now. Base metals also bid. LME copper is gapped up this morning. Thank fuck for that. Brent, I'm long by the way, obviously. Brent crude is now trading the June contract as the front month and followed May's big bearish engulfing candle with a doji yesterday. Remember, a doji is all wick, no body, a bit like myself. Getting up to $100.77 where sellers returned. $91, the level, the big figure, to 91.66 is a big area of support lower down in that one. TTF, the Dutch gas, European benchmark gas, saw red again yesterday with weakness seen to 52.27. This level is resistance this morning as we've gapped lower on the open. 46.81 is the next downside target. And finally from Clive, EU carbon markets continues its recent recovery with gains seen to 71.80, then 72.94 so far today. Gunning for the 74 to 84 kind of little range on the upside. And that's it from Clive. Thank you very much, Mr. Lambert.
Very good. Where should we start this morning? Should we start in the Middle East? Let's do that relatively briefly.
Yeah, let's do a very quick Middle East update. Over to you. So what is it, day 25 in the Thunderdome at the moment?
I believe it is, yes. So, I mean, where are we this morning? As I said, we had, a sort of pile of positive headlines, a pile of negative headlines, and they both equate to, the same volume in terms of the news flow. We'll start with the good news, because why not? We had reports via CNN yesterday that Iranian sources had said that the US had made efforts at outreach and that Tehran was willing to listen. There were also reports via Axios that we might have what they were calling high-level talks between the two sides as soon as Thursday. Other sources' stories indicated that the Iranians would prefer that those talks are with Vice President J.D. Vance and not with Jared Kushner and Steve Witkoff, because obviously they were the two that they were talking to before, and then they started getting bombed. There were also reports via Israeli media that the US had been and this was picked up later on actually by the New York Times as well, that the US have been circulating a 15.15 point plan that could be discussed in those negotiations, and that potentially along with that, they would be discussing a ceasefire for a period of 1 month, which could then be used to, come up with negotiations around a concrete agreement to bring hostilities to an end. Not going to go through all of that 15-point plan because, we haven't got the time, quite frankly. However, a lot of it is probably unpalatable to the Iranians. Although I would say, actually, again, half of Twitter have been, saying, oh, well, why would you put that down on a bit of paper when you know they're not going to agree? I mean, have you ever negotiated anything in your life? For God's sake, you start punchy. You start with, your ideal aims, and then you work down from that to a point in the middle. That's kind of how these things work, whether it be trade talks, war, or a business deal. The general principle of negotiation is pretty similar.
Or even simpler, what time should we go down the pub? I'll say lunchtime, you're saying no, Ryan, some of us have real jobs, let's start at 4 p.m. And I say, okay, let's meet in the middle, I'll meet you at 2:30.
Lunchtime. You're more saying like opening time at 10 o'clock in the morning. But yes, that is a good analogy, a worryingly accurate analogy. On the negative side of the coin, just to give a bit of balance to things, there were reports, again, via another Israeli official, this time via CNN, saying that the Iranians do not appear to be in a mode to be making concessions. There were also various reports via Reuters that apparently Iran's negotiating position has hardened sharply since the beginning of the war. The IRGC, which is the Revolutionary Guard, are apparently exerting greater influence over decision making. And we also had a report via the Wall Street Journal that the United States is deploying as many as 3,000 additional soldiers from the 82nd Airborne Division to the Middle East, but that no decision has yet been made as to whether boots should be put on the ground. Again, I mean, if you're looking at things through an optimistic lens this morning and saying that there is a bit of light at the end of the tunnel and we might be getting closer to the end of this than the beginning, you're going to point to some of those positive headlines. I think that's certainly what financial markets are picking up on this morning. Crude benchmarks are lower. Brent's back under $100 an ounce. Government bonds are rallying, and equity futures are up by 1 to 1.5% on each side of the Atlantic. If you're of a more pessimistic disposition, you're obviously going to point to some of those negative headlines and say it's all well and good that the US are talking about negotiations, but they're sending more troops to the region. So does that mark an escalation? Frankly, I don't know. I don't think anyone knows. Anyone who tells you they do know definitively what's going to happen next is probably pulling your leg. And this is why we see such a huge amount of headline whiplash and very, very choppy trading conditions, which frankly are only going to continue until, well, we get some sort of concrete information as to exactly what's going to happen next, whether that be escalation or de-escalation. And then it starts again, I think you were going to say.
Yeah, no, exactly that. And but the problem is, and then even if something is resolved, markets are still going to be jittery for a long period of time because it only takes one bad actor to kind of spoil it for everyone again, and then we kind of go back into this kind of vicious circle. Just one thing to note, or a couple of things to note on the energy front. Obviously, the US have loosened restrictions on Russian crude again. Obviously, if you remember, the original move was to allow the selling of Russian crude that was already on the water. Apparently, they're loosening restrictions a little bit again. And also, there's been some commentary out of Brussels saying that those policymakers in Brussels and in the EU are looking very, very closely into allowing Russian energy products to flow more freely into Europe to kind of help out the energy crisis that is impacting the region. So again, Russia, the big winner here by all accounts.
Yes, although the EU are going to need about 15 summits in order to that one out first, aren't they?
But the
But
trade that never loses is get long caterers for EU summits.
yeah, exactly. The other thing, actually, just on the energy front, is there were some reports this morning. I'm not sure who they came from, but the administration in the US are apparently looking at waiving some of their gasoline rules that they put in place in the summer. This is, I'll be honest, it's something I didn't even know existed until about 7 o'clock this morning. Basically, there are various rules and regulations around the ethanol content that you can have in gasoline in the US in the summer months. This is basically around air quality regulations. The nub of this is the US are potentially looking at relaxing those regulations, which would obviously mean that you can have, slightly higher ethanol content in the fuel, which in turn means that more fuel can potentially be put on the market. And again, hopefully easing prices somewhat. So again, just something worth bearing in mind. Also, any ag traders out there, ethanol, corn.
Yes. You say ease prices, as you said, rightly tweeted yesterday, day before, the US are seemingly waking up to the fact that the rest of the world, well, Europe pays a lot more for fuel. Welcome to the club, guys. Your fuel is still much cheaper than ours, so get a grip.
Although the only thing I would say about that is that at least the surge that they've seen in fuel is driven by genuine market forces and not, Rachel Reeves just going, I want some more money.
Yes, quite. Speaking of Rachel Reeves, what a great segue this was. And again, well, Michael might make notes. I certainly don't.
We'd never have guessed.
I don't know if that's being apparent, but Bank of England and the great rate repricing. What are we looking at now? 85 basis points of hikes pricing.
I don't know. Hang on, bear with me 1 second, and I will load up the brilliant warp function on the Bloomberg terminal, and I will tell you. Hang on.
If I'm remotely accurate here, I'm going to pat myself on the back.
Actually, you're not, I'm afraid. So the market at this moment in time is pricing about 60 basis points by the end of the year. That's obviously on the back of the inflation numbers we had this morning, and also just kind of a spillover from that.
I'm so sorry.
Positive tone.
Sorry. In my defence, it was at 85 at one point.
Do you know what? It actually, the close yesterday was 78, but I just didn't want to tell you that.
Fucking. Oh, God. Right.
Anyway, seriously, this does bring us on to a broader point, because just to put some context around it, at the end of Feb, so the 27th of Feb was the last trading day of last month, the market was pricing 52 basis points of cuts from the Bank of England. At one point, I think last Thursday or last Friday, after the March MPC meeting, we were pricing 95 basis points of tightening from the Bank of England. So basically 150 basis point swing in terms of those rate expectations. And now we're pricing about 2 rate hikes by the end of the year.
Yeah, it went a bit crazy. When we were at the point of, near as damn it, the best part of 4 hikes, it was getting very, very silly. And funny enough, I was talking to the guys at Alpha Pick saying, I'm not stepped into the STIRS market in quite some time, but this is begging to be traded. I didn't, obviously, because I probably went down the pub. And then we see today's data, the CPI data, and it's come back, which is nice. But I still think it's a bit bonkers pricing, to be honest. What's your opinion?
Well, I completely agree. And I think, you look actually pricing across the board, even, the ECB markets are still pricing in, well, what have we got from the ECB? About 75 basis points of tightening by the end of the year. Even if you look at the Fed, markets are pricing about, what are they pricing now? About 5 basis points of hikes, but they priced out all the cuts from the Fed by the end of the year. I think this goes back to, I think there's a combination of things going on here, and we've covered this briefly previously. I think the first issue is markets are assuming that there is a very linear relationship between energy prices go up, which means spot headline inflation goes up, which means central banks hike rates. That's very, very oversimplified version of how central banks' reaction functions actually work, because what they're looking for is not where inflation is now, but where inflation is likely to be in between 1 and 2 years' time looking forwards, because that's the lag over which monetary policy works. So the market has kind of ignored that a little bit. The other issue is positioning. You've got to remember that this is not some sort of abstract number. It's not a sort of straw poll of market participants. They are actual futures contracts that are being traded on exchanges by traders putting their money on the line to express a certain view. And, all of those traders, or the vast majority of short-term interest traders, would have been long going into March, because we were in an environment where we were talking about, central banks potentially having to ease more due to weak labor markets, et cetera, et cetera, et cetera. So you've also got the element of those positions being stopped out, which will have exacerbated the move.
Do you know what? I'm glad you raised that, because I was going to suggest something very similar, because we're seeing, we've seen pretty much everyone on the MPC, the BOE's MPC, pretty much every economist, everyone you talk to says that market is completely wrong here. There was no one saying that this is a good market, or this is a fair price, which brings us to, why are we trading here? Because we were trading there inside. And I was about to say, we know some very chunky stirs brokers, etc. So I might need to take some of those out for a beer and
get some stories.
But it does strike me as some kind of quite significant position unwinding, because people have been caught with their pants down and they've been forced to trade these prices.
Yes.
Rather than they want to. And again, this would explain why we've had this overshoot in times of stress, which is exactly what we've seen, and why we've seen the market come back. So the elastic band snap back a little bit. I still believe it needs to keep coming back, but yeah, I think you're exactly right to flag that. I think this could be more of a market dynamic story than just a true pricing story.
Yeah, I think it very much is, certainly from some of the stuff I've heard over the last couple of weeks. I think that's slightly more than conjecture, but we probably shouldn't say any more unless we're in the pub. The other thing to just bear in mind is, where monetary policy is right now. And what I mean by that is, you need to think about the Fed funds rate, which is between 3.5% and 3.75%. The BOE's bank rate is at 3.75%. The ECP's deposit rate at 2% is a slightly different situation. But the BOE and the Fed, coming into this energy price shock, are already running policy above the neutral rate. So the policy stance is already restrictive. So the real question for me is, why would you see a need to make policy even more restrictive than it already is? Surely if you just remained restrictive for a bit longer, i.e. just stood pat and held rates where they are, that would do enough if you're worried about these risks of second round effects, which I think are relatively low anyway. So again, I think that's another part where the market's kind of lost, almost can't see the wood for the trees, where we're looking at, crude prices being up 40% in the last month. UK natural gas prices are up 70% in the last month. TTF is probably up more. And the market's kind of gone, well, energy prices up, that means inflation's going to go through the roof, which means they must hike rates. That's really not the way that these things work. And I agree with you. I think we probably will see a degree of a retracement in this pricing, whether that comes from a move in commodity prices, or whether that comes from, kind of massaging and rhetoric from various rate setters and policymakers across developed markets. I don't know. But I can't imagine that many of these central banks would be especially happy with how hawkish a path the market is currently pricing in.
Absolutely not. And especially for the UK, unfortunately, mortgage prices is starting to really take a bit of a toll on the housing market now. My new favourite Twitter account is a Twitter account, let me find it quickly, called @LondonPriceDrop. And all they do is go to Zoopla and post every hour or so a significant, a property that's been sold recently or fairly recently, well below what it was sold for previously. And I'll give you a clue, whoever's running that account is getting busier and busier. So it gives you a sign of what's kind of in store and what, issues that this raises for the government and Rachel Reeves, etc. And let's be honest, she doesn't exactly perform well when things are going well. So if things do take a turn, which they significantly are, God help us. But anyway,
I would just say, actually, just on the house price thing, because this is a bit of a common sort of misconception that a lot of people seem to have, which is, London house prices just go through the roof every month or every year. And yeah, that's kind of true in nominal terms, but in real terms, London house price growth has been flat since about 2015, 2016. I believe someone will go fact check me on those numbers. So it's not as if the sort of prime central London market was firing on all cylinders before this started.
No, quite. In actual fact, when I was doing a bit of looking around for a rental, I was kind of dreading it, thinking I was going to find a 2-bed in Central for just a small apartment. I was thinking, oh God, when I was looking and renting a few years back, I would say paying 3.5 or whatever. I was thinking they're going to be 5. and it basically was exactly the same, no movement. And I was
Yeah.
like, well, hang on, that was a bit of a surprise, but a pleasant one.
Well, yeah, quite. Don't
And it,
complain too much. Don't ask
yeah,
any questions.
and it might mean that you see far more of me, Michael. There you go.
Oh, wonderful.
What's
Shall we
going
do
on
the day
today?
ahead?
Yeah,
Right.
exactly.
Well, we've already had the inflation figures out of the UK that we touched on a second ago, but just for the interest of good order, headline prices rose by 3% on an annual basis in February. That was unchanged from where we were in January. Core CPI, that ticked up to 3.2 from a prior 3.1. And services, that ticked lower to 4.3 from a prior 4.4. And that's actually the slowest pace of services inflation since March of 2022. Although, again, all of that is before the energy price shock, so it doesn't have much bearing on what the Bank of England do next. As for the rest of the day, at the top of the hour, we get the latest IFO sentiment surveys out of Germany. Of course, we had the PMIs yesterday, which largely disappointed because obviously everyone's reacting to the uncertainty as a result of the geopolitical situation. You'd expect the IFO data to largely reinforce that message. Besides that, there is no other real economic data of note. We do have plenty of ECB speakers, though. Today is the annual ECB Watchers Conference, which sounds like possibly the most boring event anyone could possibly think of coming up with. But nonetheless, we are due to hear from about 6 or 7 members of the Governing Council, including President Lagarde and Chief Economist Philip Lane, who'll be speaking throughout the day. We do have a 5-year Treasury auction at 5 o'clock this evening. The 2-year auction yesterday was actually pretty ugly. It tailed the when issued by 1.8 basis points, which is the biggest tail since March of 2023, which was obviously when Silicon Valley Bank was in the process of blowing up. So the 5-year sale might attract a bit more attention than usual on the back of that. And last but by no means least, Ryan, your best mate, Fed Governor Stephen Myron, he will be speaking a little bit later on today on the subject of digital assets. And of course, geopolitical headlines continuing to dominate as we move through the day.
Exactly. No better time to be checking out PIQ because we have actually decided to post less of the news on the main account. We're actually doing more of the news on the PIQ News Wire account or whatever it is on Twitter. But again, the best way to follow it is to use PIQ's platform, especially our new little standalone desktop version for just the news and business TV. Shameless plug. There you go. Contact me for details, etc., etc. It's free. Michael, thank you. Pleasure as always, my dear friend. I'll see you down the pub. Listeners, thank you for listening. As always, we really do appreciate you. Keep it tight, stay safe, try and stay out of trouble.